So I just want to jump on here real quick to talk about my industry projection for 2026 and 2027. Last week was actually very crucial. The Fed industry projection has changed, and the main reason is oil. For months, market were waiting for rate cuts. Consumer were waiting for low mortgage rate. Business were waiting for cheaper loans. Investor were waiting for the Fed to finally pivot and cut rates. But now, because of the oil crisis, that entire timeline is getting pushed back. Barclay now expect no Fed rate cuts in 2026. Before, they expect the Fed to cut rates in September. Now, they believe the first rate cut may not happen until March 2027. That is a major change. And the reason is simple. Oil prices are rising. Higher oil price can push inflation higher. And if inflation stays higher, the Fed cannot easily cut rates. So in this video, we're going to break this down very simply. First, we'll talk about the oil crisis. Second, we'll talk about the Fed. And then we'll answer the real question. Are rate cuts still coming? Or did the oil crisis just kill the Fed rate cuts plan? Now, let's start with oil. A lot of people think that oil only matters because of the gas price, but it is much, much bigger than that. It affects trucking, it affects transportation, it affects airline, it affects food, it affects manufacturing, it affects plastic, chemical, fertilizer, and the list can go on. So when oil price goes up, it does not only mean you pay more at the gas pump. It means the cost of moving goods goes up, the cost of producing goods goes up, and the cost of delivering goods goes up. And eventually, those higher costs can show up in the prices that consumer pay daily. That is why oil is so important. Oil is one of the few prices that can spread through the entire global economy. And that is exactly why the Fed is paying close attention. Because if oil's price stay high, inflation can stay high. And if inflation stay high, rate cuts become much harder. And rate has to be higher to fight inflation. That's the first key point. The oil crisis is not just an energy problem, it is an inflationary problem. And because it is an inflation problem, it becomes a Fed problem. Now, let's talk about why oil prices are rising. A major concern is the Strait of Hormuz. This is one of the most important oil choke points in the entire world. A huge amount of global oil and gas move through this region. So when there is conflict in Middle East, market gets nervous. And they do not wait for the worst case scenario to happen. They start pricing in the risk before it happens. That's why oil price can move so fast. It moves literally from $60 to $120 in less than 2 weeks. So if trader believe oil supply could be disrupted, oil price can rise immediately. And this create a chain reaction. Oil goes up, gas price go up, shipping costs go up, business costs go up, inflation pressure goes up, and then the Fed has a problem. Because the Fed is just trying to bring inflation down, but oil is pushing inflation risk back up. So this is not just about Middle East. This is not just about oil trader. This affects the entire global economy, and it directly affects the Fed interest rate projection. Because if the oil crisis continues, the Fed may not have enough confidence to cut rate. Now, let's talk about the Fed. The Federal Reserve just held interest rate steady at 3.5 to 3.75% at their last Federal Reserve meeting. That part was expected. But the important part was the vote. The vote was 8 to 4. That is unusually divided. And it tells something important. The Fed does not agree on what comes next. One Fed official wanted to cut rate. That side is worrying that the economy is slowing down. But three Fed officials were concerned for the opposite reason. They did not want the Fed to keep signaling that rate cuts are the most likely next move. That side is worried about inflation. So the Fed is split. One side is saying the economy is weakening, we may need to cut. The other side saying inflation is still a problem, we should not promise cut. And oil is making this debate even harder because higher oil price can create inflation pressure at the same time the economy is slowing. That is the Fed's nightmare. Inflation risk on one side, economic weakness on the other, and no easy answer in the middle. Here's why the Fed cannot easily cut rates. The Fed job is to bring inflation back down to 2%. but inflation is still above the target. And now oil prices are adding new inflation pressure, as you can see in this consumer price index chart. If the Fed cut rates while oil prices are rising, they could make inflation worse. Lower interest rate make borrowing cheaper. Cheaper borrowing can increase demand. More demand can push price even higher. And if inflation expectation rise again, the Fed now has a much bigger problem. That is why the Fed has to be careful. They may want to cut rate. The market may want them to cut rate. Consumer definitely wants them to cut rate. But the Fed cannot just cut rate because people want relief. They need inflation to cooperate. And right now, oil is making inflation less predictable. That's why rate cut expectations are being pushed back. The Fed is basically saying we need more evidence. We need evidence that inflation is cooling. We need evidence that oil prices are not going to create new inflation wave. They need evidence that the labor market is weakening enough to justify cuts. And until then, they may have to wait, and that means higher rates for longer. So what happened next? There are three possible scenarios. Scenario number one, oil price fall. This is the best case scenario. If oil prices cool down, oil price comes back down, inflation continues moving lower, then the Fed gets room to cut rates. In this case, rate cuts are not canceled, they're just delayed. The Fed can say inflation is improving, the economy is softening, and now we can lower rates. That will be the soft landing scenario. Scenario number two, oil price stay high. This is the higher for longer scenario. If oil price stay elevated, inflation stays sticky, and consumer keep facing higher costs, the Fed probably holds rate steady. No hiccups, no major pivot, mortgage rates stay high, credit cards still stay expensive, auto loans still stay expensive, business borrowing still stay expensive. This is a scenario where the Fed waits. They do not want to raise rates unless they have to, but they also cannot cut rates because inflation risk is too high. Now, for the final scenario, scenario number three, oil price rise and the economy weakens. This is the worst case scenario. Inflation stay high because of oil, but consumer also start pulling back. Business slow hiring, unemployment rises, growth weakens, and the Fed is trapped. If they cut rates, they risk making inflation worse. If they keep rates high, they risk making the slowdown worse. This is the scenario the Fed wants to avoid. But this is also why the oil crisis matters so much. Oil could determine whether the Fed cuts whole or even talk about hiking rate again. So here's my main projection. If oil price stay elevated, rate cuts are probably not going to come anytime this year, 2026. The Fed will most likely hold rates steady, and the market will push rate cut expectation further into the future. So you will see borrowing costs that will still stay high, mortgage rate will still be sticky, credit card will still be painful, and all along will still be expensive. And if you invest into the stock market or gold or crypto for that matter, the market, that entire market may have to adjust to the idea that the Fed is not going to cut rate anytime soon. And that is the main shift. Before the oil crisis, the market was asking how many rate cuts are we getting? Now the question is, are we getting any rate cuts at all? As you can see in these target rate probabilities by the end of next year. And the answer depends on oil. If oil price fall, rate cuts come back into play. If oil price stay high, the Fed waits. If oil price spike higher, the Fed may have to sound even more hawkish. That does not mean rates high are guaranteed, but it does mean rate cuts are no longer guaranteed either. That's the point. The Fed is not in control of everything. They can control interest rate, but they cannot control oil supply. They cannot control geopolitical conflicts. They cannot control shipping disruption. And they cannot simply ignore energy prices if those prices start feeding into inflation. So right now, the Fed is watching oil very closely. So should everyone else. That's all for today. That's my outlook on rates based on the current oil crisis and the current federal community stand on inflation. Thank you for watching.